Hi, welcome to the next webinar in our ongoing series on women, divorce, and retirement. I'm your host, Lily Hampson, and today we'll be discussing the issues involved in divorces when one spouse owns a business or it's co-owned. Our guests today are Philip Hertzberg, the lead financial advisor of Team Hewins, and family law attorney Lauren Gronsky. Would you guys like to say a few words to introduce yourselves?
I'm Lauren Gronsky. I'm a family law attorney in the state of Florida, and I'm also a Florida Supreme Court certified family mediator with over a decade of experience helping families with issues such as this, like dividing and distributing a family business throughout the divorce process. And I'm looking forward to being here. Thank you for having me.
Thanks, Lauren.
My name is Phil Hertzberg, lead financial advisor at Team Hewins, fee-only wealth management firm that specializes in financial planning and investment management. I have over 18 years experience in the profession and enjoy helping professionals and those facing life transitions, such as divorcees, deal with wealth management challenges. So I'm excited here to be on the show with family law attorney Lauren Gronsky, as well as you, Lily, and Bob Powell, and want to thank you all for inviting me to be here.
Thanks so much, you guys. So by the end of this webinar, we hope you'll have a better understanding of the financial and legal implications of divorces involving businesses. You'll also know how to protect your financial interests in a divorce, and if time permits, we'll have a time for audience members to post questions in the chat and our experts can take a look. So I figure we should just jump right in. First question and topic we're going to discuss is what happens if a business is one of the assets in a divorce? So how do the parties proceed? Lauren, we can start with you if you'd like.
Certainly. Well, I just want to make a blanket statement that I am licensed in the state of Florida. And so the answer regarding businesses will vary from state to state or jurisdiction to jurisdiction. However, as a general matter, if a business is an asset in a divorce, it'll typically be treated like any other asset. There will be a valuation assigned at a particular point in time, and the parties will have one of two big options, and that is either to split the asset, right, to distribute it, or to have one other spouse, buy out the other's interest so that it may continue on in some manner. But it will be distributed as part of the divorce pursuant to the laws in that state. And if the couple chooses to do something different, let's say they don't want to follow the law, they want to make an agreement amongst themselves on what will happen, that is certainly an option.
Awesome. What about you, Philip? What's the financial side of this?
Yeah, well, just to add to what Lauren is saying and to go into some of the financial details here, just in general about divorce, the sharing principle generally applies to all marital assets, meaning that those assets should be shared exactly equally between the divorcing couple. So the first step you want to do is to quantify all the assets owned by the couple in their sole or joint names and either held directly or indirectly. The next step is you want to characterize them as marital for sharing or non-marital, which means generally to be retained by the owner. So when a family business owned business is involved, you have to make sure there's a fair distribution of marital assets, including the business, and that requires careful planning and the assistance of legal counsel. So if your business is categorized as a marital asset, as Lauren said, it will be valued and distributed like any other assets. In other words, it will be valued and the value will be equitably distributed, in this case, between you and your spouse. So if you want business assets such as real estate, equipment, vehicles to be divided in a divorce, it's important that you name the business as a party in the divorce. And just to also wanted to add one other point here is some spouses are satisfied with just getting the value of the business in cash.
Yeah, to add on to that, it's an important point to note that because it varies from state to state, it will be different, and it's important to consult with an experienced family law attorney. But if it's an asset, which was how the question was posed, there is this threshold question of, well, is it a marital asset or is it a non-marital asset? And in the state of Florida, that's how the analysis would begin. Now, as I said, if it is a marital asset, then we have this issue of distribution. But even where it's not a marital asset, right, that term, that legal term of art, there are still implications. For instance, if that non-marital asset accrued any additional interest or gained value throughout the marriage in our state, in Florida, that could be considered an asset, a marital asset to be distributed, the enhancement in the value. So it's important to learn the laws in your jurisdiction, but to understand that it will be distributed. And if the parties can't decide what to do with it, then typically a judge is going to apply the laws of that state.
Great. We'll be touching on how it varies between state to states later. But for now, can you guys talk about what happens when both spouses are involved in the business?
Certainly. All right. Well, typically this is a family business scenario. And oftentimes these businesses are formed either before or during the marriage. And, it comes down to a practical matter of whether or not these people want to continue conducting business together or separately after the marriage, and whether or not it's feasible. But, this is not uncommon in a family business situation. And I've seen this go many different ways. Now, a judge is not going to force former spouses to work with one another, right? That makes sense. But there are many instances where people would rather not sacrifice maybe a very successful family business just because the marriage is coming to an end. And so people will come up in mediation, particularly people will come up with very unique plans that are tailored to this family to decide what's going to happen to this business. Is one spouse going to step down and let another person fill their role, or are they going to continue conducting business side by side? What were the original roles in the first place? So this is highly variable. It's going to depend on the parties and whether or not they're willing to do it. Other than that, if there's an inability, then typically these sorts of businesses are dissolved and the parties would have to distribute the proceeds according to their agreement or to what the court orders pursuant to the law.
Thank you, Lauren. Yeah, there's just no one size fits all answer when it comes to what happens to a family business when both spouses are involved. So assets owned prior to the marriage that remain separate and are not used or relied upon financially by the couple during the marriage retain, generally speaking, non-marital status. If you own shares in your family business at the date of the marriage and received, say, by way of gift or inheritance, and you play no role in the family business at all, the entire value of the shares on divorce is generally almost not a marital asset. So, it all depends on whether you're a director or have some active role in the business, especially managerial or giving some sort of direction. Then any increase in the value of the business during the marriage can be treated as a marital asset. So this assessment is very fact specific. If you hold, for example, a non-executive directorship, then the court will kind of look at the reality of your involvement in the business, such as frequency of you being involved in meetings or any decision-making powers to determine if an increase in value of the business is a marital asset. So, just a lot of different moving pieces in terms of whether, the determination of what happens, with what happens to a family business when both spouses are involved there.
And just to tie that concept home, just to tie it up, whether both spouses are involved or not is almost irrelevant when you look at the law in the state to determine who owns it, if it's marital or not. Because a non-marital business, a spouse can work in it and could be the greatest asset to that business. But at the end of the day, in a dissolution, it's a non-marital asset that they're not entitled to. And if there, let's say, was no increase in the value and all of that, there's just nothing for them to go after, then you may have a very unhappy party who put blood, sweat, and tears into a non-marital business. And then you have lawyers making claims in any jurisdiction, against a property, a business in this case, that may or may not pan out, but you have to be ready and willing to fight it. So even if one spouse doesn't have an interest, but they believe that based on the work they put in, or maybe the goodwill that they brought, right, to the business, that they should get something, they'll find a lawyer to take that position, and you find yourself in litigation. So later on, we're going to talk about some tips to avoid some of these mishaps that can happen. But certainly you'll have some very unhappy people at the end of this issue if both spouses were heavily involved in the business and it's only, awarded to one for whatever reason, right? It's a very interesting question.
Yeah, so I guess it makes sense now that we talk about how marital share is determined. Like, what steps usually go into that? Lauren, do you want to go first?
Sure. As I said before, this is state specific. So you're going to have to look to the statutes in your state and the case law and what it says. But typically there's going to be either a blanket rule that there are states called community property states, and there's a blanket rule, that if it's formed during the marriage, it's community property. But even in states that aren't community property states, the law is such that, for instance, in Florida, if a business is opened during the marriage, it will typically be considered a marital asset. I say typically because there are some minor exceptions, like where parties have prenups and they have agreements in place. But the share will be determined by the law. If the parties can't agree who's going to take what share, whether it's 50-50 or any alternative, then the law in that state's going to is going to apply. And then depending on the percentage of the ownership, a valuation is typically done. And that's how one party can ascertain the dollar amount that they're entitled to. And typically this is done in the equitable distribution stage, or the stage where the court or the parties are distributing equitably the parties' assets and liabilities. And so it will be done with a valuation and an understanding of what their entitlement is under the law. They can't agree otherwise.
Thank you, Lauren. That was well said. I really just have to go over or try to share the two key factors that influence how a marital share is determined and classified during a divorce. And the first is state laws, as you said. And second is the treatment of property during the marriage. As far as the state laws, and it really, those laws define marital property and how to divide property in a divorce. And to learn how your state handles marital property, please consult with an attorney who is well acquainted with the state marital property laws. And then as far as the treatment of property during the marriage, how you and your spouse manage property during your marriage can impact its classification in divorce. And this includes how you get, manage, and use the assets together. Those factors play a role in property division during the divorce proceedings. Separate property can become marital property simply due to commingling of funds.
It's a very important point that Philip makes, and that is that people will raise an interest in otherwise non-marital assets, or assets they may otherwise not have an interest in during the divorce, based on treatment. And we had some big upsets with a case that came down a few years ago here in the state of Florida, whereby there was a prenuptial agreement, but the way the parties treated this asset transformed it into a marital asset that was subject to distribution. And it was to the tune of over $1 million. It was not a small sum. And so we have to be very careful in how we go about protecting ourselves. Like I said, we'll discuss that at the end, and how to prevent people from saying, well, they always said this was my business, right? We held this out to the community as our family business. I was the one at the front desk, or whatever the argument may be as to how it should be altered from non-marital to marital if it's going to be distributed. That's a great point, Philip.
Thank you, Lauren.
Really great points, both you guys. So moving on to our next topic, what happens in a personal service business where a special license is required by the owner? And in this case, maybe one spouse possesses the license or the degree. Phil, do you want to go first?
Sure, I'm happy to go first. Some examples of personal service businesses, just to inform everybody here, are legal, medical, or accounting businesses. And laws and regulations regarding these professional practices, personal service lines as marital property vary by state by state. So consulting an experienced family law attorney like Lauren in Florida can help you navigate the process of handling a professional practice in Florida in a divorce settlement. So when there are two spouses that run a family business, oftentimes the spouse who has a greater involvement gets the business while the other spouse gets compensated for their ownership stake. In the case of a professional practice, for example, the special licensed professional will more likely maintain ownership of the business.
That's exactly right. That's what we see in practice, because as a practical matter, the other spouse is not qualified to conduct the business, right? And so even in cases where they decide to continue working alongside one another after the divorce, what you'll typically see is parties agree to the spouse holding the license will buy out the non-license holding spouse of their interest. That spouse is compensated fully for their value of what they own in the business. And then they'll even maintain a position, perhaps as an employee moving forward, fairly compensated for the role that they're doing, but no longer as an actual owner. And that's just in cases where parties cannot continue to conduct the business as owners together. There are many states that prohibit law firms or certain types of businesses from being owned by non-lawyers, right? And so you'll see cases where the business is outright owned by one spouse, but it's still a marital asset. And in that case, we'll have to distribute that non-owner, non-license holding person, that spouse, to distribute their fair share of what they would be entitled to under the law in their state. And then if they want to continue working there or not, or if they never work, whatever they want to do, the parties are free to decide. A lot of people do continue working in these types of situations together, but as a practical matter, if you don't have the license, you're not going to be able to run the business and conduct business without the other spouse. So.
Yeah, that makes perfect sense. So kind of switching gears here, what are different ways that a business is valued in a divorce? Lauren, do you want to go first?
Yeah, so there's many different ways that this can be done. Parties can literally look at the bank statements and agree on what they want to value it at, right? They can say, we agree that it would be valued at this. If we took our assets minus our liabilities, this is one way to do it. Every state does vary on how to do this. Oftentimes we'll get a formal business appraisal done. Sometimes a broker can help it with an informal opinion. But I'll say that in even my state, because this is a hot button issue, there was no guidance really on how to address this issue in the state of Florida. In the law, there's a committee right now that's working on adding in language to say how a business will get valued in a family law case. And I'll tell you that as of right now, what they're saying should be the law, and what's being debated is whether or not the language is being chosen, is that the property would be in Florida, the property would be valued based on how it would change hands with a willing buyer and a willing seller, right? With no pressure from either side, but fair market value essentially. And I think it even says fair market value, that it would change hands between a buyer and a seller. So you can look at that. But if you want a formal opinion, an appraisal will always be the best option. And even a forensic accountant, when they get their hands the on the books, can oftentimes come up with what they believe the business would be valued at. So there's many different ways. I know Phil is a financial expert, so he'll tell us what his experience is. I'm sure he does this frequently.
Yeah, thank you. All excellent points, Lauren. It underscores the importance of bringing in the professional team when needed in these cases, and most of the time they are needed. So I wanted to go back and just add that there are a variety of ways to determine the value of the business, as Lauren mentioned. One way is simply to estimate the value of the business by comparing it to similar businesses. It's like, this is just like looking at comparables if you're in the real estate market looking for a residential house. Another way to evaluate the business is to, employ a forensic accountant or professional appraiser to review the information about the business, which includes tax returns and financial statements, so you get an independent assessment of the value of the business. And that's where a couple different important approaches come into play. The first is the asset approach, compares the assets and liabilities of the business to determine the value that a forensic accountant may use. Secondly, there's what's called an income approach, places a value on the business by looking at the cash flow of the business. So it is important. Very oftentimes, a family law attorney like Lauren, and somebody who, like myself, may be on the team, the professional team, is going to need to engage a forensic accountant during the divorce process, especially if that divorce involves a marital estate with significant assets or debts, or one party owns or is a partner in a small business. A forensic accountant can be an invaluable resource. You've got parties sometimes taking great efforts to disguise their true earnings, using business and debts and expenses, multiple accounts, or real property to absorb or hide their income. And then oftentimes parties will seek to devalue their assets and provide an incorrect appraisal, possibly using invalid valuation methods. So you need that assistance there of a forensic accountant, so the parties and their attorneys can be left to rely on information that is valid. And it eliminates the guessing that may need to be done if you're concerned about hidden income or assets. So don't hesitate to engage a forensic accountant as part of the legal and advisory team if needed.
And what Philip's talking about, these are known as experts in the field. And when you have an expert witness testify on your behalf in court, obviously it strengthens your position. And your lawyer can't testify to what the business is worth, and you may not be qualified as the owner. So you have these professionals do it. What you'll often see is each spouse will hire their own experts, and then you have what's called a battle of the experts. But to answer the question, even when there are two battling expert opinions as to what a business is valued at, it's ultimately going to be up to the judge to decide. And that's a really important thing to note. At the end of the day, regardless of what, they usually are going to pick one or other, one of the two experts, but the judge is going to decide what the business is going to be valued at based on what was presented. And it may not be the expert that you hired. So it's a very important thing to pay close attention to. And yes, make sure you have a good team of professionals, not just your lawyer.
Yeah, absolutely. So for our next topic, we should talk about what the tax implications are when one spouse is taking the business in a divorce. Philip, do you want to take that one first?
Sure. First, what you're going to want to do when looking at the tax implications of one spouse taking the business in a divorce it's important to first understand the true value of the assets. And with that said, you have to be mindful that assets of equal amounts are not worth the same. So in short, a retirement plan account or a Roth IRA does not have the same value as a business because the assets have different tax treatment, as well as different provisions related to divvying up the assets. If spouses choose the buyout option, for a business, there are a few tax implications that are important to understand. When a spouse pays a sum of money to buy out their ex's spouse share in the business, this sale is not treated as a taxable transaction. In fact, in general, all transfers of property between spouses during the actual divorce are treated this way. So generally speaking, spouses can only enjoy these benefits under certain circumstances, which include they transfer the property within a year of their marriage settlement. Secondly, they could also transfer the property within 6 years after the marriage ends if transfers are made pursuant to a divorce agreement. They could also make these transfers before the divorce and allow the transfer of property between the spouses to not be treated as a taxable transaction. And the transfer could be made at the time the divorce settlement becomes final. Now, fast forward things maybe a few years later, and if spouses then turn around after the property transfer has occurred pursuant to a divorce agreement and sell their share in the business to a third party years later, they would generally be required to pay capital gains taxes on the appreciation. So in addition, it's important to recognize that buyouts are only possible if the purchasing spouse has the liquid assets necessary. That means they have to have accessible cash on hand to actually complete the transaction. There could also be, in addition to federal capital gains implications, also it depends on the state the couple resides, with those completing the sale. So any gains from the seller is also subject to be taxable through state income tax, depending on the state that one lives in.
Tax issues are highly specialized, and unless your family law attorney is a tax professional in some capacity, they really should not be advising you on the specific tax implications of your case. There should be a blanket referral to a tax professional, or an accountant who can answer those specific questions, because it is outside of the realm of what we do. Now, we have to consider tax implications, but I'm not qualified to tell you what those specific implications will be. So that's why a team is important to understand it. But as Philip mentioned, and it's really important to note, transferring property, and a business is property, transferring any sort of asset in a divorce, depending on your jurisdiction, there are exceptions to whether, if you were to transfer property under normal circumstances or a retirement account, as he mentioned, there are tax implications. But when you're doing it pursuant to a divorce, you may be able to avoid tax implications. And I think that's the big take home for the people who are listening is consult with a qualified tax professional and ask about whether or not you may be able to avoid some of the usual tax implications because this is happening pursuant to a divorce.
Absolutely, and you couldn't have said that better, Lauren. Before talking to a client and having them go forward, we can run some projections based on estimates here in the office as a planning team. But in general, we will also share that with the CPA, and we'll also advise the divorcing client who's selling, the property, to make sure that they consult with their qualified tax professional before moving forward on completing the sale and recognizing the gain.
That's right. Best practice.
Mm-hmm. Great points, guys. So also, when it's a family business, it may not only be the spouses who are involved in the business. In this case, if there are employees involved, how would you say that they're usually affected?
I just, this is again one of those instances where it's going to be highly fact specific, excuse me, and that's because what's going to happen with the business is going to depend on, what these people either decide or what a court orders. Now, just like any change in structure in a business, the employees may be affected if there's a change in management or in daily operations. But I will say typically, if the company is going to continue on in some manner that is like what was going on during the marriage, then the employees may remain unaffected altogether. So it's going to depend on what happens. Now, certainly you can imagine a scenario where if the company is going to be dissolved, each and every employee is going to be intimately impacted. But short of that situation, you're going to look at internal changes in structure, what that may entail for certain employees, or, just leaving everything the way it is to the extent that that can be done. And I think that's ideal unless internal changes needed to be made. I think allowing the business to run effectively and smoothly despite a divorce taking place would be the ideal situation for any family business or any business that supports a family rather.
Yep, you've said well spoken again, Lauren. The only thing to add here is that if businesses are divided or sold, the employee of the business, may be impacted. The spouses will ultimately need to decide what will immediately happen to the employee, such as whether they will remain with the company, be laid off, or transferred to another company.
That's right. Important decisions.
Yeah.
Definitely. Great points. Moving on. So what landmine should a business owner be wary of when dividing a business? Anything in particular to look out for?
Philip, do you have any specifics that you can think of off the top? I'm happy to elaborate as well.
Sure. I think it really all depends on how the business is divided. So, there are three options just to go over here with the audience, and there could be pitfalls, with all the options, but some more than, some landmines or pitfalls more than others. In the case where first one spouse keeps the business, it's the most common solution and seems to work best for most couples. One spouse buys out the other spouse's interest in the business. That's generally when an agreement comes in place and everybody seems like they're at least somewhat content with that. There aren't as many pitfalls with that as there is if two spouses decide to sell the business and divide the proceeds. The positives there are both parties are free to look elsewhere for another business or even to retire. However, there are always like mixed emotions there with what happens there. It's almost like selling the business. It depends how emotionally tied a spouse is. It can almost be like a death of a family member, in addition to going through an agonizing divorcing process. Another drawback to this approach where both spouses sell the business is it's difficult oftentimes to find a buyer. It can take possibly years to sell a business, and we're right now in a higher interest rate environment, so it may be difficult for business decisions to be completed, especially where financing is involved. In the meantime, until the businesses are sold, decisions must be made still, with both spouses as far as whether they want to continue working together, which brings us to the third and final situation. And we tend to see it more in amicable divorces or even the collaborative process, where both spouses keep the business and may choose to operate the business together, even if they're getting divorced. So oftentimes this may not be a great situation either. Even though on the surface it seems, like this would be the best solution, especially if both spouses are agreeable. It's much, because and they do this because it's it's tough for these spouses with all their hard work to just let go of the business they've worked to side by side with each other every day for years. But trying to divide the business may kill it. This doesn't work for everybody. It only works maybe for couples that are better business partners than marital partners and are able to work together in a business after the divorce is final. So there are just naturally speaking, because the marital relationship has dissolved, there are oftentimes concerns whether both spouses can keep the business running together for their future generations when that happens. You're looking at it here. A lot of spouses are looking at it, if they're not looking to sell it immediately, they have concerns about whether this business can get to the next generation without having a tremendous amount of challenges.
That's absolutely right. These challenges are varied, right? And like the answer to the previous question, a lot of this is going to be case specific, tailored to the unique family's needs, but the unique needs of the family, however we want to put it. I'll say that just to add a couple things. I've seen situations where the business has certain debts, and in the distribution process, one of the spouses gets assigned half of those debts, but they have zero intention of paying those debts, and the company is still going to continue operating, but now they've got unpaid accounts and can't continue. And so there's practical problems that you want to avoid, like making sure you keep debts even if you wouldn't have had to, but because you know that you'll pay them. And that should actually balance out somewhere else. Maybe you get to keep something else because you did that. You kept that debt. That's something I've seen happen. Another pitfall is when you unfortunately become equal shareholders with your former spouse that you don't get along with, right? Could you imagine like having to be at a shareholder meeting and get anything done when when there's, equal power, or one person has veto power? I mean, it's a true, we should have thought of this before, but people do end up holding shares in a company and thereby wielding power just by virtue of divorce. And so I think it's worth mentioning at this point. I think we're going to talk about it before we end, but the biggest landmine to be wary of is if you own a business or you are going to open a business, the landmine is operating under a marriage without a pre or post-nuptial agreement. Because as we're going to talk about, that's the landmine that the lack of the agreement is the landmine. And it's why we're having this discussion today. It's why we can fill an entire hour on what happens with a business, because most people don't have these agreements. And so if you want to avoid the biggest pitfall, so we've named some different pitfalls, right? But you want to avoid all of them in one shot, you can control the outcome of your divorce by employing a lawyer and engaging their services for one of these agreements.
Yeah, great. We'll definitely touch back on prenups and postnups in a second. But for now, how about how the state somebody lives in? How could that affect this process? For example, particular aspects that might vary that come to mind between states? You want to go first?
Phil, you want to? Well, I'm going to make a very simple statement.
Go ahead.
This is going to depend on the state you live in. The state you live in is going to determine the outcome of what happens with a family business. Like I said, I'm qualified to say what may happen in the state of Florida under certain circumstances because I'm licensed here, but without consulting with a family law attorney in your state, there's going to be a lot of questions. There's going to be a lot of unknowns, right? I find that the scariest part for clients getting a divorce is not the reality of what's actually going to happen. It's not knowing what's going to happen. And so this question is the question, so the question was, how does the state that someone lives in affect this process? This is literally the question people walk into the lawyer's office with. What are my rights in the state? And so I just caution everyone listening to make sure that you find an attorney that you trust, that you're comfortable with giving you this advice, because it's going to be determined by the law in your state, and that varies from state to state. I mentioned earlier, because you asked for specific examples, some states are called community property states. Those are specific states where they operate under a certain community property principle. Other states are equitable distribution states. Others, so it varies. And you're going to want to make sure that everything you heard here today, everything, you take in a general concept, because even though what we're saying is accurate, it's always going to come second to what the lawyer in your state says applies to your case. So you'll get valuable information here, but the answer is always going to be, to hire someone who's well-versed in your state and can tell you specifically what will happen within a degree of certainty, because of course we're not fortune tellers per se, but we do our best to give an honest prediction based on our expertise.
It's paramount to consult with your attorney who's well-versed with state laws. I wanted to mention here, to just add to what Lauren is saying, it's when you're determining whether a divorcing couple lives in a community property state or in an equitable distribution state, in a community property state like California, Texas, among others, the division of marital property is generally equal. The idea is that each spouse has an equal interest in the shared property. And, of course, the law is never simple, so there are exceptions. Generally, any gifts or inheritances given to one spouse during a marriage are separate property. It's important to note, commingling that property with community property can change its characterization. Just to make it clear here, in equitable distribution states, the division of property is not as straightforward, and the concept of equitable distribution emphasizes fairness rather than equal division. So courts in general may consider factors to fairly divide the property there in the equitable states, distribution states, during the divorce process.
Great. And just a reminder to everybody in the audience, if you have any questions, it does look like we'll have time for our experts to field them. And for our last and honestly potentially most important topic to discuss, prenuptial and postnuptial agreements. Lauren, you want to go first?
Yeah, absolutely. Well, a well-drafted prenuptial or postnuptial agreement would have precluded this entire program today, because what we discussed was what happens under the law if parties get divorced and there's a business. Now, if you take nothing away from this program, take away the fact that a prenuptial or postnuptial agreement, when drafted properly, could avoid everything that we spoke about here today, potentially every issue, by settling the issue of what happens to a family business or a business or an asset in general before or during the party's marriage, so that upon divorce, that agreement is entered with the court and put into action. And Philip and I discussed various outcomes that could arise when a divorce is pending and a business takes place. The main, two were the outcomes where the parties either sell and split the proceeds, or one spouse continues the business and there's a buyout. In either of these circumstances, we have to decide what happens. And litigation on such an issue can cost tens of thousands of dollars. People who litigate the issue of what would happen to a business, or how to value the business. There are so many different issues that can be litigated. A prenuptial or postnuptial agreement will avoid that. What you do in a case where you own a business, or you may be starting a business, and you're either getting married or you are married, is you speak to the lawyer. You say, I own this business, or I'm considering owning this business. What are the implications in case of divorce? So first, educate yourself. Then you tell your lawyer, well, I would like this to happen instead. For instance, I would like to keep 100% of my business in case of divorce. That's what the lawyer starts to put into the agreement. And without going too deep into the post-nup or prenup process, the lawyers for both parties, or both parties with or without counsel, will eventually negotiate the terms and come to an agreement. But at the end of that process, you'll have a settlement that states the answer to all of the questions we asked here today. And it'll state it according to the wants and needs of each party. So there'll be no unknowns. There'll be no need to tune into podcasts to see what will happen to my family business, even though we want all the viewers, the webinar. But my point is that it really will empower you as a business owner or as the spouse of a business owner to solidify your rights at a time when the parties are not fighting, at a time when you and your spouse may be amicable. So that's the best way to do it. The alternative is, of course, what we discussed here for almost an hour, which is what happens when people get divorced and they didn't have this agreement in place. Lots of costly, stressful litigation, potentially, and a drain on the family's resources and on energy, because just engaging in this kind of battle is exhausting. So if you want to, and I'm going to let Philip elaborate, but if you want to know the answers to all of these questions, empower yourself by you and your spouse coming to an agreement to what you want. Because remember, the laws of the state that you live in were drafted by your legislature. And the case law was decided by judges. And if you don't think that they should be the ones to determine what happens to your business, the pre or post-nuptial agreement is your tool. It's your out. It's your ability to say, I'm glad that the legislature came up with their rules, but we are going to follow our own rules. And as I keep mentioning the word empowering, it's incredibly empowering because you get to decide the outcome of your own life, not the legislature or a judge, right? Because that's the last resort. If you can't decide, as a judge is going to make a decision. And certainly making a decision regarding your own business is going to be ideal in any circumstance, especially where there's children, where this is a family affair. So, Phil, what are your thoughts?
Well, Lauren, you really highlighted the importance of prenuptial and postnuptial agreements. And the takeaway here is that these agreements would prevent the business from becoming marital property. I'm just going to walk through a couple of common scenarios where premarital and postmarital agreements are viable options during this process. So prenuptial agreements are very commonly utilized as an estate planning tool to help individuals and their partners avoid common disputes pertaining to properties and businesses. Failing to have a prenup in place may give a surviving spouse control about determining if and how business assets will be distributed to others. So ultimately, the beauty of the prenup is that it can potentially save your client substantial money and time should their marriage abruptly end. If you are already married and did not negotiate an agreement, consider asking your partner for a post-marital agreement. Your spouse may not be willing to give up all the rights already acquired as a result of the marriage and may insist on financial consideration for any interest he or she does relinquish. You may still be able to work out terms that protect the business if the marriage breaks up. So an agreement signed by you and your partner that excludes quote unquote outsiders from running or owning the business will not deprive your spouse of his or her marital rights in a divorce. Again, very common, a post-marital or post-nuptial agreement may come into play, for example, and we see this oftentimes, prior to gifting an ownership interest to a child or a grandchild. Somebody who's a business owner might require the married recipient of the gift, their child or grandchild, to execute a post-marital agreement with the recipient spouse. So just, this requires a lot of forethought out of the business owner, who insists that any family member who has an ownership interest in the business, who may acquire a future interest, consider or actually should be swayed into entering a prenuptial or postnuptial agreement.
I just want to add one thing, and that is exactly what Phil is saying. Lots of businesses require it. Many corporate structures, they will not allow you to hold shares or to be a partner in the company without a prenup, because they don't want that unfortunate surprise where a shareholder dies and now all of a sudden they're doing business with their spouse. And that's a reality. So you can imagine the pitfalls that would happen there. And to avoid all of that, many companies implement rules that say if you want to be part of this business, and even families, as you said, Phil, when they're giving gifts, they do this because they want to give a gift to their child, but not necessarily the child's spouse, for whatever reason, in case it doesn't work out. Even if they think they're wonderful, it's still, I love the takeaway to be that you are actually in control of all of this if you want to be. And the way to do that is just to consult with a lawyer, explain your situation, your facts and circumstances, and let them tell you if an agreement could protect you in any of these specific scenarios that Phil was just mentioning, or whatever your scenario is.
Well said,
Great.
Lauren. Again, I just one quick item here. I mean, in terms of utilize, I said the word swayed, and a lot of times a family member will talk to their child or their grandchild, and they'll have a discussion, and the child or grandchild who is marrying who's marrying their spouse, or they're well into their marriage and trying to gift or an interest here. A lot of times, when one spouse is having a conversation with another spouse about a prenuptial postnuptial agreement, it's a very challenging conversation. It's not a fun topic, but in essence, when it comes to matters related to the family business, it's a loving and caring thing to do to address this matter. And there are professionals that you can work with, that you could work with, divorce, family law attorneys like Lauren, to get guidance and to make sure that this is done appropriately. So it really is an important item to address when it comes to the family business.
It's a great point. Don't take it personally. It's business.
Yeah. And just to clarify for those watching, a prenuptial or pronuptial agreement would supersede state laws. Correct.
That's correct. Each state has their own laws on what an agreement that's enforceable would entail. In Florida, we have the Uniform Premarital Act. So we have our own statute that governs this, and it must be followed to a T. In your state, you will have laws that govern this. And so what the agreement does, it allows that to be put in place during the divorce, as opposed to the law, which would govern otherwise. So, very empowering tool. And for anyone who's a sophisticated business owner, it's something that should be a part of the business structure. There should be, even if you decide not to do the agreement, consulting with the lawyer is invaluable, and then you can do whatever you want. But knowing your rights and not having to, wonder what's going to happen, tremendously valuable if you're running a business.
Truly so valuable information. And like you said, everything that we've talked about can be easily avoided if you just were to have that difficult conversation and work out the knots beforehand.
That's right. And a good professional should help do that without conflict.
For sure. It looks like we have a question in the chat. So should business owners value tangible assets differently from intangible assets? Philip, any comments first?
Yeah, I can lead off here. Before we address this question, I just wanted to make clear, and I think it was touched on earlier in the program, it's vital for business owners, and they can work with financial planning professionals or their attorneys, or anybody on their team. It's vital to compile a comprehensive list of business assets and their values. And business assets, they make up a wide range of different types of items, which include, the physical, more tangible assets like real estate, equipment, inventory, and then the more financial assets like cash, bank accounts, and accounts receivables. So intangible assets are complete, they have different valuation, and those are more like intellectual property, trademarks, customer list, and phone numbers. At some point in time, the financial planning professional or anybody or the attorney is going to want to consider bringing in a business valuation specialist or what's called a qualified business appraiser or other financial expert to help them get an accurate valuation. So because obtaining a business valuation with the tangible assets and even more challenging, the intangible assets, is a very daunting task. So you're going to want to have those specialists and those other experts there to make sure that the valuation is on point, because the valuation of a business and its assets can impact the calculation of other divorce matters like child support and spousal support, which is alimony.
Yeah, and I'll just say sometimes, so certainly we want to value the tangible assets as well. To answer the question, we are not going to treat them differently. We want to assign a dollar value, but how do you value a tangible asset if it's like a piece of equipment that you bought, right? And it's typically going to be the resale value. And a lot of times when people buy furniture and furnishings and they spend a lot of money on that kind of storefront look, those things don't hold value. It's going to be what you could get at a garage sale. So unless it's equipment that holds intrinsic value and doesn't, lose it over the years, you're going to look at a lot of disappointment when it comes to valuing those tangible assets, unless it's real estate at this time. But the equipment, the furniture, the front desk, whatever you're going to add up, you have to understand that the value is not going to be what you paid for it. It's not going to, even a piece of equipment or a vehicle, because lots of companies own vehicles, it's not going to be what you paid for it. It's going to be what you can resell it for now. And that's why having a qualified appraiser is important. They're going to do all of this. They know what they need to do in their state, and they've done it before. So, but it's a great question because so many businesses have both tangible and intangible assets.
Definitely. And it looks like that was all of our questions, but if either one of you have anything that you think the audience should know if they're in this situation, how they should proceed. I know, Phil, you said there's something you think you wanted to bring up?
Certainly, Lily, I appreciate you recalling. I'd like to just make a point that in addition to a prenuptial, postnuptial agreement, a shareholder or operating agreement can also be useful in protecting business assets. So for everybody here, a shareholder or operating agreement outlines ownership and transfer restrictions. Transfer restrictions can prevent the transfer of a portion of a business. Requiring shareholder approval for a transfer is a common way to restrict transfers. The other contract that that is important in protecting business assets is a buy-sell agreement. And a buy-sell agreement can safeguard a business in a divorce when there are multiple owners. And this agreement outlines what happens to the business shares if a divorce occurs. This agreement, buy-sell, may include provisions that require the sale or buyout of the divorcing spouse's ownership interest. So consider that, consider those agreements. You can speak with your divorce business attorney on the professional team as far as ensuring that is there. during a marriage, or you have concerns of a breakup of a marriage before that happens. That's also great insurance in addition to a prenuptial or postnuptial agreement.
Yeah. There are many different options that you want to speak to a lawyer beforehand about this. So the time to ask these questions is not to wait until you're getting divorced, but at any time prior to that. And that's not to say if you are considering divorce and these questions are arising for the first time that you've done anything wrong. Not at all. But if you're able to address these issues while the temperature is low and everyone is amicable and there's no divorce pending or no breakup or anything like that, well, then certainly people come to the table with more level heads, cooler minds, and are willing to do what's in the highest good of the family at that time, as opposed to when a divorce is pending or about to happen, people will tend to think less rationally, we'll say. All right. So address these issues. And then I'll also just say, because it was alluded to right at the end by Phil, how difficult this could be. And then I added in there that these conversations, a good professional should be able to do this peacefully. But everything that we said here today is meant to preclude a big fight, right? Not to encourage one. So if raising the topic in and of itself is going to cause conflict, it may not be for you, but you may need to work with a professional to navigate how to do that peacefully. Some people will get offended at the concept that you may present an agreement so they don't have to deal with all the issues we discussed. But as I said before, it's not something to take personally. And you have to think of these types of safeguards and protocols almost like insurance agreements. You're going to pay an amount, you're going to get the service, it's going to protect you if and when you need it. Hopefully you never need it. We say, hopefully these agreements go in the drawer and we never take them out. You should stay married forever. But in case it doesn't, you're very happy to know that the issues were settled. Other than that, everything we said today is accurate, would happen in case of a divorce, and you could have some idea or some guidelines as to what would occur otherwise.
Great. Thank you so much, you guys. And thank you to those in the audience for attending our most recent installment on Women, Divorce, and Retirement webinar. We hope you feel more prepared in the event of a divorce. If you have a business that you're, pardon the noise, I'm sorry, if you have a business that you're trying to mediate through. And thank you so much, Lauren and Phil. Again, this is Lauren Gronsky, owner of Law Offices by Lauren Gronsky, and Phil Herzberg, the lead financial advisor from Team Hewins.